Some people may tell you about all the money they made in the stock market. Others may tell you about all the money they lost in the stock market. Hi, I'm Clark Atterbury. I've been a financial advisor for over 30 years. And in this video, I'm going to share with you 12 big mistakes that new investors almost always regret. And if you stick around till the end of the video, I'll share with you one extra bonus mistake that you would also want to avoid. A word of warning, making these mistakes could cost you dearly. Let's talk about them so you can avoid them. Mistake number one is trying or expecting to get rich quick. If you're considering investing in something that promises to get you rich quick, to double your money in a day or a week or a month or something ridiculous like that, just know that's not how prudent investors invest. That's gambling. You might as well go to a casino. Maybe you'll double your money, maybe you'll lose it all. If something sounds too good to be true, it probably is. Mistake number two goes along with mistake number one, and that is not doing your due diligence. If you don't understand something, don't invest in it. Mistake number three is using leverage to invest, or margin investing. We've all heard stories from the Great Depression about people who were wiped out. A lot of those people were harmed so badly because they were buying stocks on margin. They were borrowing money to buy the investment. If you're buying on margin, the problems are twofold. Number one, you're borrowing money and you're going to be paying interest to somebody else, which could offset any potential gain you would have realized. And number two, if the stock moves against you, you can end up losing more than the full value of the stock. Invest your own money. Don't borrow to invest. Mistake number four is not understanding your risk profile and investing in a way that's true to it. One of the things we always do with our new clients is we go through a risk analysis where we talk about how much fluctuation can you bear? What is the appropriate mix of investments to be in your investment portfolio? It's not the same for everybody. And one of the things I've learned over the last 30 years of serving clients is that the clients who get hurt are the ones who invest in a manner that is not true to their risk profile. We as human beings have a psychological threshold. And if we get pushed past that, we tend to make emotional decisions that can hurt us. So it's important to take the time to understand your risk profile and to make sure that you're investing in a way that's consistent with it so you can hang in there when times are tough. Mistake number five is investing without understanding what to expect. You have to understand that there are cycles to the market so you're not surprised when they go down and think that there's something wrong. The markets, the economy, will go through cycles, and the investor who does well is the one who understands that and doesn't get too scared when things are on the down part of the cycle or too irrationally exuberant when things are on the upside of the cycle. Investors also need to know what to expect from owning stocks. If you own a beautiful, diversified stock portfolio, it is still going to fluctuate. And sometimes people say, oh, it was worth this, now it's worth that, so I've lost money. You have to understand that you haven't lost money just because the markets are down. You still have your shares of the company. What you are experiencing is a short-term price fluctuation. It's perfectly normal to experience short-term price fluctuation, but a price fluctuation to the downside is converted into a loss only if you sell it while the price is down. Think of it like you own a house. Imagine you buy a house for $500,000, then there's a bad real estate market, and the house, if you were to turn around and sell it, you would only get $400,000. Have you lost $100,000? The truth is, just like with a house, just because it was temporarily worth less doesn't mean you lost any money. Because what if you didn't sell it and you kept it and years later you sold it for $1 million? You didn't lose $100,000. You made a bunch of money, but along the way you did experience significant short-term price fluctuation. It's vital that you understand that going into it so you know what to expect, so you're not spooked out, whipped out of the stock in a downturn. Mistake number six is one of the biggies, and that's failure to diversify. If you're going to invest in stocks, if you invest in just one stock, you might do great. You might do better than the market as a whole, but it could also become worthless and never come back, and you lose all your money. Those of us who are old enough will remember Enron. Enron was a company that was a golden child, blue chip stock. All the analysts loved it. Great profits, great everything. You can't go wrong with Enron. Well, guess what? Enron ended up going to zero and never coming back. So if you had your money only in Enron, you would lose all your money, and that's that. If, on the other hand, you diversify among different markets, large cap stocks, mid cap stocks, small cap stocks, growth style, value style, international stocks, as well as domestic stocks, short-term bonds, intermediate-term bonds, long-term bonds, high-yield bonds. This is all on the menu. I'm not saying this is for any of you, but these are ways to diversify among different markets and then to diversify in turn within each of those markets using things like index funds to build out the different portions of your investment portfolio. That way you're invested among different markets as well as within each of those different markets, literally investing in thousands of things versus 1 or 3 or 5 or 10 things, eliminating the risk that any one thing could destroy your portfolio. Mistake number 7 is one of the very biggest mistakes, and that is trying to time the markets. When you try to time the markets, you're trying to outsmart all the other investors. You're trying to say, I know better than the others, and I'm going to get out now, and I'm going to get back in. Of course, you have to divine 2 perfect things. When's the perfect time to get out, and when's the perfect time to get back in again, which is nearly impossible. Warren Buffett, the great investor, the Oracle of Omaha, has been known to say he's never met anyone, himself included, who could consistently time the markets. Studies show that the average long-term rate of return on a stock market mutual fund is something like 10% per year. Meanwhile, the average rate of return for the average stock market mutual fund investor is something like 6% per year. 6%, 10%. Why the difference? Because they're trying to time the markets and it costs them. This shows that most investors trying to time the markets are more likely to underperform the market than to outperform it. Mistake number 8 is failing to stick to your disciplines, failing to stick to your plan. Let me give you an example. One of our clients, consistent to his plan, had been investing $1,000 every month into his IRA account. However, when the markets got scary and things were bad, he called in and says, I've heard the markets aren't good and that I should not be buying. And so he wanted to stop investing in his IRA. Imagine you had an objective between now and the time you retire to accumulate as much toilet paper as you could. And you're used to paying $1 a share. And then one day you wake up and you hear it's down to 75 cents per roll. Would it make sense to stop buying it and say, I'm not going to buy it again until it goes back up to $1? Of course not. If you can buy your rolls of toilet paper at 75 cents versus $1, you're going to be able to acquire a lot more rolls of toilet paper. Well, the same thing applies to investing in a retirement plan or mutual funds or diversified portfolio. When the market goes down, last thing you want to do is stop buying. You want to keep on buying and stick to your discipline, stick to your plan. Mistake number 9 is day trading. When you're day trading, you're trying to time the markets. You're trying to outsmart everybody else. Make no mistake. It's gambling. If you want to gamble, then fine, go ahead and do that. But if you want to manage your money prudently, your serious money, long-term money for the rest of your life, don't delude yourself into thinking that day trade is prudent investing. It's just gambling. Mistake number 10 is not keeping a long-term investment perspective. If you want to invest prudently, you're going to want to be patient. Again, we're not laboring under the delusion that we're going to get rich quick. We have a long-term strategy and we'll stick with it. Sometimes I'll tell a client a great investor would be Rip Van Winkle because you lean against a tree and you fall asleep. You don't look at the market every day, every month, every quarter, every year. You wake up 20 years later, you look at your account and you say, wow, look how great my portfolio did. Whereas the person who looked at it every day, every month, every quarter, every year, had a lot of unnecessary stress and was probably incited to make emotional reactions that were not in their best interest. Mistake number 11 is following the herd. Just because everybody else is doing something doesn't mean you should. Everyone else is buying with irrational exuberance. Everyone else is selling due to fear. But you have your own unique financial plan and your own discipline. You don't want to follow the herd. Don't be listening to the financial news headlines and doing what they think you ought to do because they're interested in ratings. They're interested in sensationalism. They're not interested in your best interests. Mistake number 12 is not having an emergency fund. We've talked about sometimes the markets are down and you're going to want to wait and ride out the down period, and the markets have historically always come back. But if you're in a position where you have to have money and you don't have money elsewhere, then you may be in a situation where you're forced to sell your investments when they're down, and then you can convert temporary price fluctuation into a loss. So make sure you keep an emergency fund so you'll have plenty of cash should you need it. I promised you at the beginning of the video that if you stuck around to the end of the video, I'd give you an extra bonus mistake to avoid, and here it is. Do it yourself investing versus working with a financial professional. Let me just share with you a quote from George Classon's The Richest Man in Babylon, which if you have not read it, is one of the great fundamental financial books. You should read it. He said, "Be not too confident of thine own wisdom in entrusting thy treasures to the possible pitfalls of investments. Better by far to consult the wisdom of those experienced in handling money for profit." And that's what we've been doing for over 30 years. Our contact information is in the description below the video reach out if we can help. For an even deeper dive into how to manage your investments for the long term, watch this video next.